What's happening, everyone? CME just pulled the trigger again. Second margin increase in 72 hours flat. First one landed January 28th. Now round two hits Monday, February 2nd. That's less than 24 hours from now. Let me break down the numbers for you. Gold maintenance margins jumping another 33%. Silver getting hit with another 36%. Platinum taking another 25%. Palladium climbing another 14%. These aren't isolated moves. These are stacked increases, one on top of the other. To put this in perspective, the cost to maintain a single silver contract was sitting around $25,000 before this whole thing started. After the first hike on January 28th, it jumped to roughly $66,000. And Monday morning, that number climbs even higher. The message from the exchange is clear. They're scrambling. And Monday's market open is going to reveal exactly how deep this crisis runs. But here's the part that makes Monday genuinely unprecedented. Physical silver has effectively disappeared from the wholesale market. Bullion Star's founder, Tory Personson, released a trading update on Saturday saying they're not certain they can acquire any additional silver inventory at all. Those aren't my words. That's directly from one of the largest bullion dealers on the planet. Golden State Mint pulled silver sales for the entire weekend. They couldn't lock down supply. The only other time they did this was during the pandemic panic of 2020. Baird & Co. Sires, the largest precious metals refiner in the United Kingdom, shut down their entire online sales operation. The physical market is separating from the paper market in real time. And Monday's opening bell will show us if paper can maintain the illusion or if the whole thing finally cracks wide open. Before I go any further, I need to address something directly to the newer viewers. I don't sell courses, I don't run a paid membership, I don't offer signals or mentorship programs, nothing. If someone contacts you claiming otherwise, block them immediately. They're using my name to run a scam. What I do here is simple. I present the raw data. I don't push hype. I don't manufacture fear. I don't play on greed. The messages I get from this community tell me this approach works. People say this content helps them understand both sides of the market, see past the noise, and make smarter decisions with their own money. I exist on two platforms only, X and YouTube. My handle on both is identical. That's your verification that you're dealing with the real source. Anything outside of that, I take zero responsibility for. Protect yourself accordingly. I will never attempt to sell you anything. Now here's where I want your input. Drop a comment below with your outlook. What's your read on silver heading into next week? What does your gut say about Monday's open? I want to hear your perspective. Let's tie together everything we've been tracking this week. Friday delivered the metals crash. Silver dropped 31% in a single session. That's the largest daily percentage loss ever recorded. I walked you through how JP Morgan closed out 633 silver short contracts right at the absolute bottom. Perfect timing, perfect exit. They're out. We analyzed Kevin Warsh being positioned as the next Fed chair and what his anti-QE balance sheet reduction stance means for liquidity. Markets sold off hard on that policy pivot away from unlimited money printing. Now CME responds with a second margin hike inside 72 hours, conveniently timed right after extreme volatility and some of the sharpest price drops in modern history. The official justification is improved risk coverage. What traders actually see is a calculated move designed to squeeze over-leveraged long positions out of existence. The cost to hold positions is about to spike dramatically. That triggers either forced selling or violent price swings, possibly both. Here's what I'm tracking in real time. Shanghai spot silver sits at $122.13 right now. COMEX is printing $85.33. The Shanghai premium is $36.80. That translates to a 43.13% gap, but it gets more extreme. On JD.com, China's dominant e-commerce platform, gold bars are moving at approximately 50 Sambatter 20 per ounce. Physical silver bars are listed at $163.35 per ounce. Run that math. That's a 91% premium over US COMEX prices. I need you to hear that again. JD.com silver at 163, COMEX silver at 85, a 91% disconnect. The gap between paper pricing and physical reality has never been wider. According to pure supply and demand fundamentals, silver should be trading around $130. Every historical instance where we've seen a 30% discount from fundamental value, silver has snapped back every single time. This backwardation has to resolve. You cannot sustain physical metal trading at 91% premiums while paper simultaneously crashes. One of these markets is lying, and the physical market is screaming that paper is the fraud. Let me give you the exact words from the dealers themselves. Bullion Star, it remains uncertain whether we will be able to acquire any additional silver inventory at all. Golden State Mint, forced to halt silver sales entirely, unable to secure supply. Baird UK, complete online sales shut down. Here's Bullion Star's official statement. Throughout this period of market revaluation, dealers have witnessed extreme and unprecedented physical demand. At the same time, replenishment options have become increasingly scarce, with physical metals drying up and mints operating under enormous backlogs. In such an environment of constrained supply and sustained physical demand, sharp price declines in the paper markets are difficult to reconcile with the realities of the physical precious metals market. That's their direct quote. Not my interpretation, their words. Physical demand at extreme levels, supply completely constrained, mints drowning in backlogs, and paper crashes 31%. This disconnect is exactly what we've been documenting all week. Monday will stress test whether it can hold or whether it shatters. Now we need to discuss Bitcoin because in my previous breakdown I said monitor whether Bitcoin closes the weekend above 82 or breaks below. It closed at 78. That's not the bullish signal I was looking for. That's my honest read. Bitcoin is sitting at 78 as I record this. If Monday's open fails to show strength, a drop to 74 or lower becomes realistic. And if Bitcoin breaches 74, Michael Saylor's position goes underwater. That's a psychological line that could cascade into broader selling across crypto and risk assets. So tonight's Asian session matters more than any single factor. Shanghai futures, Hong Kong markets, Tokyo, they get first crack at price discovery. If Shanghai silver holds $120 or pushes higher while COMEX sits closed, that signals physical isn't panicking despite the margin assault. If Shanghai gaps down and follows COMEX lower, that confirms selling pressure has gone global. Asia sets the tone, Monday follows. Quick reality check on the subscriber numbers. Roughly 75% of you watching right now aren't subscribed. If this unfiltered, real-time analysis is cutting through the noise, if you're getting genuine edge from seeing the complete picture from both perspectives, if this is helping you make sharper decisions, hit that subscribe button. That's how we build a community grounded in truth rather than manufactured hype. If any of this adds value to your process, drop a comment. It tells me what resonates with you and keeps this channel focused on what actually matters. I'm not here to promise the moon. I'm not here to call for zero. I'm here for the people who want substance, actual clarity. Not the polished, scripted, shallow commentary saturating every other channel. Right now we're watching two parallel universes collide. Paper reality shows CME hiking margins twice in 72 hours. Silver crashing 31% Friday. Warsh selected as Fed chair with policy analysis calling it bearish for metals. Dow futures down 300 points as the Warsh sell-off continues. Options traders registering the most bearish positioning on the US dollar in recorded history. Physical reality tells a completely different story. Silver has posted 9 consecutive green months. That's the longest winning streak in history. Gold has stacked 7 straight green months, also the longest streak ever recorded. Dealers are shutting down because inventory doesn't exist. Shanghai premiums at 43%, JD.com premiums at 91%. China's gold imports from Russia hitting record highs. Dealer statements describing physical demand as extreme and unprecedented. One of these realities dominates on Monday. Either margin hikes trigger another wave of forced liquidation and paper maintains control temporarily, or physical scarcity becomes impossible to ignore and paper pricing loses all remaining credibility. Monday's bell answers that question, and then there's the Iran situation. The Americans should know if they start a war, this time it will be a regional war. Direct quote from Iranian officials. Trump has announced troop and warship deployments toward Iran. Qatar's foreign minister delivered what's being described as a final message to Iran's supreme leader. The response, "We will not start a war, nor do we wish to attack any country, but our people will deliver a powerful blow to anyone who attacks them." Escalating Middle East tensions create another potential catalyst for precious metals. If something breaks overnight or Monday morning, safe haven flows could completely override the margin hike selling pressure. Let me walk through both scenarios for Monday because this is genuinely binary. Bearish case first. CME margin hikes activate Monday morning. Traders who survived Friday's massacre now face demands for 33% more capital on gold, 36% more on silver. Anyone who can't meet the call gets liquidated. Forced selling continues. Paper prices drop further even as physical disappears. Friday's price action felt like pure forced liquidation rather than fundamental selling. Monday could deliver more of the same. Bitcoin at 78 looks weak. A break below 74 puts Saylor underwater, triggers crypto selling, spreads risk-off sentiment across all assets. Asian markets gap down, Europe follows. US opens soft with Dow futures already showing 300 points red, selling feeds on itself. Warsh policy analysis reads as extremely bearish for metals. Stronger dollar makes metals more expensive internationally. The core thesis for holding gold, hedging against money printing, weakens if the Fed actually shrinks the balance sheet and kills the printer. Iran tensions could spike. Any military incident sparks panic selling before safe haven buying takes over. Phase 1, liquidation continues. Everything sells as capital scrambles for exits. Margin calls cascade across asset classes. Friday's $15 trillion erasure could become $20 trillion by Monday, close as contagion spreads. That's the bearish scenario. Paper overwhelms physical in the near term. More pain precedes any recovery. Now the bullish case. JP Morgan covered shorts Friday at the exact bottom. Major banks exited their positions. Short interest is materially lower now, less structural suppression on the next move up. Physical holders across China and India refuse to sell at 78.90 levels. They're not budging. Dealers can't source metal. Mints are buried in backlog. This builds a concrete floor under prices. CME margin hikes might represent the final desperate play. They're protecting clearing firms from a player potentially in trouble. If physical demand holds, if Shanghai premiums stay at 43%, if JD.com stays at 91%, the COMEX pricing mechanism loses all legitimacy. Monday could mark the inflection where physical finally wins. Silver has 9 straight green months, gold has 7. Longest streaks in recorded history. Friday's 31% crash didn't break the structural bull market. That was liquidation mechanics, not fundamental rejection. Every historical 30% discount from fundamentals has produced a snapback. This pattern suggests opportunity, not termination. Bitcoin at 78. If Asian markets stabilize, if Bitcoin holds and pushes back toward 82.85 Monday morning, sentiment flips. Risk appetite returns. Crypto stabilizes. The forced selling stops. Iran tensions could de-escalate. Qatar's message could lead to diplomatic resolution. No strikes. Geopolitical premium bleeds out. Markets bounce. Financial conditions index sitting at 98.3, lowest since early 2022. Fed has cut rates 175 basis points since September 2024. Dollar down 12% over 12 months. Investment grade spreads at their tightest since 1998. Financial conditions have returned to pre-rate hike levels. Asset owners are winning. This macro backdrop supports higher asset prices the moment forced liquidation exhausts itself. And here's the nuance on Warsh that markets are missing. Initial reaction painted him as a hawk. His actual positioning is more complex. He's bullish on AI and productivity gains. He believes AI-driven efficiency allows the economy to expand rapidly without triggering inflation. That gives him political cover to support rate cuts even during strong economic prints. He's not the boogeyman the knee-jerk sell-off suggests. He wants rate cuts. He just wants balance sheet discipline alongside them. Rate cuts without QE might pressure short-term liquidity, but it doesn't terminate the bull market. So Monday reduces to this. Asian markets tonight. Bitcoin behavior overnight. Iran headlines. Whether CME margin hikes trigger another forced selling wave, or whether physical scarcity finally overwhelms paper manipulation. I'm watching Shanghai futures with intense focus. If Shanghai silver holds $120 or climbs, that's bullish confirmation. If it gaps down aggressively, that's the bearish signal. Bitcoin needs to defend 78 at absolute minimum. A break of 74 creates serious problems. Iran needs to remain in diplomatic mode. Any military action Monday morning changes every calculation. Here's where this leaves us. 3 key takeaways and we're done. Number 1, CME margin hikes hitting for the second time in 3 days. Gold up 33%, silver up 36%, effective Monday. This either forces additional liquidation or represents the final desperate measure before physical reality takes control. Physical dealers are shutting operations. Bullion Star can't source inventory. Golden State Mint can't secure supply. Baird UK closed online sales entirely. Shanghai premium at 43%. JD.com premium at 91%. Paper and physical have completely disconnected. Monday's opening determines which reality prevails. Number 2, Bitcoin sitting at 78, looking fragile after I flagged watching for a close above 82. That was my personal read, and it didn't hold. If Monday fails to demonstrate strength, a move to 74 or below becomes probable. Asian markets tonight carry more weight than anything else. Shanghai, Hong Kong, Tokyo open first. They establish the framework. Shanghai silver holding or rising signals bullish. A gap down signals bearish. The next 12 hours before U.S. markets open Monday will reveal everything. Number 3, Warsh policy carries more nuance than the initial bearish interpretation suggested. He's dovish on rates, bullish on AI productivity, but disciplined on balance sheet management. Not the extreme metals bear that Friday's sell-off implied. Iran tensions could break either direction. 9 straight green months for silver, 7 for gold. Longest streaks in history. Friday was mechanical liquidation, not fundamental rejection. History says 30% fundamental discounts bounce back. Monday's open either confirms or invalidates that pattern. The unresolved tension is this: physical scarcity has reached extreme levels, dealers shutting down, premiums at 43% to 91%. But paper margin requirements doubled in 72 hours, forcing continued selling. Bitcoin vulnerable at 78. Iran tensions elevated. Monday opens with every one of these forces converging simultaneously. Does physical reality finally break through paper manipulation? Or does one more liquidation wave hit before the snapback? This is the most critical market opening of the entire year. Asian session tonight, U.S. session Monday morning. Everything we've tracked this week: JP Morgan's exit, Warsh policy implications, physical scarcity, sequential margin hikes, Iran tensions, all of it collides tomorrow. Stay sharp, track the data. The next 24 hours determine whether this was the final capitulation flush or whether another leg down precedes the physical victory. Execute your own due diligence. Understand the risks you're carrying. Take full accountability for your decisions. Have a defined plan. Know your time frames. Are you operating on hourly charts or building on a multi-year thesis? Position accordingly. If you're running over-leveraged, margin hikes will eliminate you regardless of where prices eventually go. That's just math. But if you're sized appropriately and you understand exactly what's unfolding, if you're stacking and waiting for deeper discounts to accumulate more like many here who've been building positions for decades and know exactly what they're doing, then let's see what Monday's opening delivers. Time will tell. If you're new here and you don't have a plan, these volatile conditions will destroy you. Invest with logic, ignore the hype, use your own judgment, never follow anyone blindly. That's the complete picture. Stay ready.